Hello, this is Mike Swanson. I run the website WallStreetWindow.com, and the odds are that you're watching this video because you got an email from me telling you that it's up. Now, if you're not on my email list, go below the video into the description and click the link to join it, because then you'll get from me before the opening bell every single trading day my email update with the top headlines I'm watching that'll impact the markets and my trading commentary, because we're at a fascinating moment. And in this video, I want to talk about what most people are now doing in the market with all the selling and the wild gyrations that have been going on this week. And also an indicator that I believe you must now use to navigate this market environment if you're looking to buy things. I think it's probably the most important indicator to use for the rest of this year. So let's take a look at what's happening now. Today, as I'm doing this video, it's roughly it's 1 p.m. On Tuesday. Tomorrow is going to be the Federal Reserve meeting, but the Dow is down 400 points, the S&P down 83, NASDAQ down almost 3%, VIX is up 8%. So, we're selling big selling so far. Hopefully there'll be a rebound today or tomorrow, but we saw a rebound yesterday. The Dow is down over 1,100 points and it finished green. A lot of people bought into that, as you'll see in a moment, and then they're trapped. But everyone is trapped who's been buying over the past several months, even the past year when it comes to many stocks such as Netflix or things such as the RKTF. These people are not trapped in losing situations. And what I'm all about is trying to help you get into things that can go up, that don't crash when the stock market does, and are outperforming the market, having stronger action than the market. That's the key to doing well in an environment like this. But that's not what most people are doing. Now, in the past year or two, I've been using a Robinhood account to show you from time to time the most widely owned stocks among Robinhood account holders. But I just found something more useful than that yesterday, and it's a link to Fidelity. You see, well, I'll just show it to you. This is yesterday's data on the close. This are the top buys and sell, the top stocks traded or ETFs by all the people on Fidelity, and it shows you whether how many of these are buy orders and how many these are sell orders. So this is more comprehensive data than you see through the Robinhood app. And frankly, it's also by people more important than Robinhood traders, because these are people with accounts much bigger than the average Robinhood account, at least $100,000, where the Robinhood people just got a couple thousand. So this is really a better representative than of what the aggregate of money among self-directed traders and investors are doing in these financial markets. Now, this is yesterday's data on the close, and there were stories showing that there was huge selling on the in the morning as the Dow fell 1,100 points on Monday. But then as the rebound happened, you can see going down this list with all the green that there's massive buying. In fact, it was the biggest one-day trading volume for the QQQs ETF in over, I think, since 2009. And the NASDAQ itself fell on an intraday low down 4.9% and then managed to close green. That was the biggest intraday drop since 2008. So that's the size of the declines or the swings going on in the market. The intraday swings are even bigger than what we saw yesterday, was even bigger than any of the swings we saw during the March 2020 market meltdown. And a disturbing thing about that is that when you see a swing like that, typically the final bottom swing is the biggest of them all. And I don't really think we've actually seen that yet. But we have to judge these markets day by day when they are so volatile like this. So you need to see what I'm thinking in the emails. But anyway, what's also troubling to me when I look at the list of the things that were bought yesterday, and we'll look at a second what's going on today. To me, a lot of these are stocks that are highly speculative, not much different than what the Robinhood speculators are buying. So for example, Rivian, a mass buy, 5,300 buy orders yesterday. LCID, Lucid Group, another one of these electric vehicle car companies that has no revenue. Coinbase, Palantir, Grayscale, Ethereum on the bottom. You would think people were investing using the turmoil to buy stocks paying dividends, stocks with growing earnings, stocks with great fundamentals and decent valuations, but no, a lot of this is speculation. And the second thing on the list is very risky. It's a triple ETF, TQQQ. So anyone who bought it yesterday on here is smashed today for a pretty substantial loss, like 6% or something, the first couple hours of trading. So what this is telling me is people on the down day in the market yesterday they weren't scared. They were mass speculating in stocks that are junk. And if they're not junk, many on the list are broken. Shopify, I'd say, is a broken stock. NEO is a broken stock, meaning they're way below their 200-day moving averages. They're badly lagging the markets. And when stocks are lagging the market averages, when the market dips, they tend to fall even more. So they're highly risky. Microsoft, I wouldn't put in that category. I wouldn't put Apple in that category either. But I would certainly put AMC in that category, GameStop in that category, and Netflix crashed 20% just last week. Ford made a big top. So people are just trying to buy these it's not good what they're buying. At the end, they're not rotating into the new leadership in the market or trying to find out what it is or anything of that sort. And if we go to what's happening today, which is right here, update as of 12:30, you see the same thing. And this is even more troubling because the market is red pretty good today, and more people are buying than selling. So that's not a sign of panic selling in the market, which is typically what you see at a stock market bottom. Instead, people are buying. Again, triple QQQs on the top of the list now is number 2. In fact, if you look, there's a triple SOX thing, and then something that more people are selling than buying is a ProShares triple QQQ ETF, almost twice as many sell orders or buys. So judging by this, the individual trader is trying to best guess the bottom today. Now, frankly, I think we're in a real bear market that's likely to last for, no one can predict it, but months, perhaps even through the whole year. The way the stock market is actually behaving is very similar to me, not to 2008, not to 2020, but what happened in March, April 2000. We're in a big financial bubble, just like we saw the internet bubble burst then. We're seeing that burst happen now throughout the stock market, or 90% of the stock market. The ARK ETF typifying these type of positions in collapse. Bitcoin, crypto in collapse, but so are so many of the stocks you see on this list, the GameStops. Even Amazon has had a smash down. And I don't think it's over. We are going to see bounces. We're going to see rallies that last for several weeks until we can get to a real capitulation low. Bottom line, this is a very volatile market. It's going to have its up days and even 1 week rallies. It's going to suck people in into trying to buy all this stuff that was hot before, and they see it move on their Robinhood account or see it on TV. But this is a market, I believe, where to make money, buying things requires a new type of thinking for a new stock market environment. And that new type of thinking means to buy things and focus on things that outperform the market, that do not go down hard when the market falls, or even sometimes goes up. And then when the market will have its real rallies, this type of stuff, because it has powerful relative strength as things fall, tends to go up even more. Because when things hold up, when the whole stock market falls, what it's a sign of is strong holders and also big money, institutional type money accumulating, which helps hold up these positions. And they do that with things that have the best fundamental value, are in sectors poised for real substantial growth, and are kind of somewhat immune to the overall turmoil going on, or perhaps even in a position to benefit from it. And there's an indicator that you can use to easily figure out, hey, is what I'm looking at here outperforming the market or underperforming the market? Is this something we should be buying or something we should be selling? That is the most important thing, I believe, to use to navigate this market for the rest of the year. Not trying to predict the daily gyrations or even guess bottoms, but to focus on relative strength, focus on new leaders in the market. The past leader stocks have been shot and they're now broken. So let me show you what I mean. A broken stock is Netflix. Netflix was a stock market leader for years. And what has happened? We're on a down day in the market again, and Netflix is down 5.2%, like 2 or 3 times the percentage that the NASDAQ is. And it's a terrible situation. So this is the type of stock you do not want to be buying, even though it's on this list of top, the top 30 most bought stocks today. Number 20, 2,300 orders in to buy Netflix through Fidelity, only 881 sell orders. Those people are making a mistake. And let me show you then how to figure the powerful indicator. And this is stockcharts.com. And we're going to add it right here. Netflix, it's a ratio. Netflix divided by the S&P 500. What this does, it divides the price of Netflix with the S&P 500 to generate a relative strength ratio. When this ratio goes down, it means that the price of Netflix is underperforming the S&P 500. So when S&P 500 goes up, Netflix goes up less. When S&P 500 goes down, Netflix goes down more. That's a losing situation. That is not what you want to be in this market. In fact, stocks with declining relative strength are dangerous in this market. On market drops, they are at risk of crashing, as you can see that Netflix has done. But Netflix was lagging, as you can see, since November. The indicator is falling since November, which was a warning. Hey, this is very risky. This is very risky. And boom, it crashes. And this can go on with entire exchange traded funds. So here's the ARK ETF. It has been lagging since February. ARK down 5% today, while the QQQs are down 2.75%. ARK down twice as much, basically, as the NASDAQ. But not just that, ARK is at a new low, intraday low. Netflix is even below the recent low, too. So what we want to do is find situations where this indicator is going up, not down. Those are the type of stocks, those are the type of ETFs to buy, not ones where the indicator is going down, the ones where the indicator is going up. And I'm going to show you one stock doing this and then one ETF doing this. I own both. And I feel quite content to own both of them, as you'll see. One is Exxon. And I talked about Exxon in a video just the other week. Indicator is shooting straight up. Look, Exxon's not crashing. Exxon just made a new intraday high today for the year. And Exxon is a bullish chart. It's actually consolidating, it appears, below 75. It's not below the 200-day moving average. It's above that moving average, but the indicator is going up. That makes me feel like it's not stressful to own Exxon. Exxon's not going crazy like it's a crypto coin. Exxon is also paying a nice dividend. Now, let me show you an exchange traded fund I own and just recently talked about in a previous video last week. IAU, this is a fund that owns gold, not crashing. The relative strength indicator has turned up since the beginning of the year. This is going up while the stock market has been going down. That's the type of situation I want to be in. And it's not stressful to own gold right now. Gold tends to trade less volatile than the S&P 500. And in market environments where gold is bullish, go up more than the S&P 500. And I think that's what we're headed for, because at some point, and I think we're months away from this, the Federal Reserve will react to the declines and turmoil in the stock market and become more dovish. But look, we're still got some rate hikes set up before we get to that. But gold is a benefit from this changing, coming macro environment. Gold is also benefits from as a safe haven for inflation, to protect the value on your money when you have money in the bank that draws no interest and loses value now because of the rate of inflation. You cannot buy a CD and beat the rate of inflation. So hence enter why gold is now an investment to protect people's money when they have a huge amount of money in the bank. They want to own some gold as protection, and that's causing gold to be more bullish. But look, when the stock market crashed in 2020, gold fell about half as much as the stock market did, and then came back and rallied even more at a faster rate than the S&P 500 did that spring. So, I'm not saying you put everything you own in gold. What I am saying is it now is serving a great function in an investment account. I've came into this year with 14% of my money allocated to metals ETFs. I own AUA in my main largest account and a couple other metals ETFs too. And I'm very happy to have that. And owning it has helped my account be less volatile than the stock market and less volatile than most people's investments accounts who have 50% of their money or something or more in the US stock market, and none in gold. In fact, as you saw, gold has not been one of the top 30 things bought or sold on Fidelity, nor has mining stock ETFs and so forth. But maybe you're not interested in gold. That's fine. What's important is what you learn from this video. Not that you agree with everything I say, but what you learn from the video. And I think the most important thing you need to learn is relative strength, how important of a concept that is. And if this is the first time you've ever heard of the concept of using relative strength to pick out stocks, sectors, ETFs worth buying, now's the time to learn about it. Go on Google, type in relative strength and find articles about it, read about it. And it's going to be a main concept that I use over and over and over again for the rest of this year, talk about in my articles, in my videos, and so forth. Because all of the playback of the past 2 years is over. And now we're in a new market environment. It's time to adapt and adjust. That's the only way to make money, not trying to jump in all the same fad stocks or trade in and out and so forth, because it's very difficult to be a day trader. That's one thing a lot of people try to do. They'll hold stocks, they'll see them go up, and then you enter the bull market's over, you have all this volatility. And what most people will try to hold and ignore the volatility, then they give up when they lose so much money. But another large segment of people, what they will do is say, okay, I can't hold, I'm just going to trade. I'm going to try to day trade. It's too risky to hold. But but what they do is try to trade the same junk or what has become junk because it's lagging the market. And it's very difficult to be a day trader. Very, very difficult to time these swings or predict them. I certainly don't pretend to be able to do that. And I don't really know anyone who can do that, with a 90% or better success rate. It's very difficult game. I like to do what few people do. It is the easiest game. Stick with what is breaking away from the stock market in terms of relative strength. Jim Cramer has a saying, there's always a bull market somewhere. So focus on that. Focus on what's above the 200-day moving average. Focus on what's displaying powerful relative strength, and go to Google, read articles about relative strength. And if this is the first time you've ever seen me, click the like button so YouTube knows people like this type of content, and then hit subscribe, and then hit the bell, and YouTube will send you an alert the next time I've got a video up for you to watch. So we'll see what happens for the rest of this day. Tomorrow's the Fed meeting and the days after that. Very interesting, a wild start for 2022, but the year has only begun, and this is still a market environment full of opportunities, but you got to do the work to find them, and you can no longer do what everyone else is doing. Being a herd trader on Robinhood is going to lead many people to complete financial ruin. They're going to end up with nothing in their account balance and shutting down the Robinhood account. And that's one reason I think the Robinhood company itself, we'll look at the stock, is a terrible investment. It was trading around $11 just the other day when it went up, to like 50 or 60 in the spring. So it's a disaster. All that said, have a good day, and I'll be talking with you later.